In this video, we will be discussing monetary policy, which is the tools of the Federal Reserve, or the central bank of the United States. This is the other option that governments have utilizing the central banks rather than going through fiscal policy, which is through the elected side of government, so in the United States through Congress and the President. Now, again, we just got done looking at what Congress and the President can do, what elected officials can do. Again, that was fiscal policy, so they can increase or decrease government spending or control taxes. Now we're going to look at our monetary policy toolbox and look at the three tools that the Federal Reserve, or a central bank of a country, has at its disposal. The three shifters of our money supply curve are the three tools that the Federal Reserve has at its disposal: reserve ratio, discount rate, and open market operations, which is a fancy way of saying buying or selling bonds. When we talk about the Federal Reserve and how they control the money supply, again, think about what our money market graph shows. We're always looking at, when we increase or decrease the money supply, what happens to interest rates. So know that when the Federal Reserve is using one of these three tools, the setting a reserve ratio, lending money using the discount rate, or buying and selling bonds, that while the initial result is an increase or decrease in the money supply, really their aim is to try to target the interest rate, the nominal interest rate. And to do that, they have to manipulate the money supply. So let's go through the three shifters of our money supply curve: the reserve ratio, the discount rate, or buying and selling of bonds. You see a picture here of our current Fed chairman, or chairwoman, Janet Yellen. She just, in the past few months, replaced Ben Bernanke, who served 2 terms. The Fed chairman is appointed by the President, confirmed by the Senate, and serves a 4-year term that is staggered with the President's term. So, for instance, Ben Bernanke was first appointed in 2006, where George W. Bush, who appointed him, was elected in 2004. Obama was elected in 2008, and then reappointed Bernanke in 2010 for a new 4-year term, which is why Yellen just started 4 years later in 2014, and she'll be there at least through 2018, barring some type of resignation. So let's look at our first shifter of our money supply curve, the reserve requirement. And this goes to the question of, do you really understand how the banking system works? What happens when you put your money into a savings account or into a certificate of deposit, a CD? Well, for banks, what they're going to do is take the money that you leave in the bank and use it to earn a profit. Again, banks at the end of the day are businesses, and so the reason they're paying you an interest rate is so that they can turn around and use your money. They're hoping that the interest rate is enough to entice you to leave your money in the bank and to delay using your money. And so when banks take in money, they're only going to keep a small percentage of that money at the bank in the quote-unquote safe located at each bank. The rest of that money is going to be loaned out. Again, if you think about what happened during the Great Depression with the bank runs, this is ultimately why banks failed. Too many people came at once to try to withdraw all of their money from the banks. The banks had loaned all that money out. The people, when the banks tried to reclaim or call in those loans, couldn't afford to pay, and so the whole system crumbled, leading to the Great Depression, or one of the causes of the Great Depression. This type of banking system is what we call a fractional reserve banking system, meaning they're going to keep a fraction in the safe and they can loan out the rest. The reserve requirement is essentially what percentage banks have to keep what percentage they have to hold in their bank. So again, when we're talking about this reserve requirement or the reserve ratio, and again, you'll see it listed as both, we're simply talking about the percentage of money in each person's account that banks cannot loan out. So when we talk about what they can actually do with this, if the Fed wants to increase the money supply, then it wants to increase the amount of money held in bank deposits. Because what happens is when banks receive more money, sure, they're going to have to hold a certain percentage of that, but they can then loan out what we call their excess reserves. And those loans will eventually get deposited into other banks, which they will then hold a percentage and then loan out the excess reserves, starting another cycle similar as we saw with the spending multiplier. That's why for the reserve ratio, we have the money multiplier. And so to walk you through an example, similar like we did with the spending multiplier, you can see the same type of process happens. A deposit is put in the bank. If the reserve ratio, what they have to hold on to, what they cannot loan out is 10%, then of the $1,000, the bank has to hold on to 100. That means they can loan out the other 900. You see this process continues, and we can see how much new money is created. Now again, I have to caution, when we say new money being created, there's not more money actually being printed. What we're doing is we're creating money by turning it over faster. So just like our spending multiplier was 1 over MPS, our money multiplier is simply going to be 1 over our reserve requirement, or our reserve ratio. So when we look at our reserve requirement, and again, just like with fiscal policy, there can be expansionary or contractionary monetary policy. Same thing, if we want the country's economy to grow, we'll use expansionary monetary policy. If we want the country's economy to shrink or contract, then we use contractionary monetary policy. If there's a recession, all right, so again, think about what or where we would be on our ADAS graph. We're in a recessionary gap. We need the country to grow to get back to full employment. So we need the economy to grow. To do that, we would want to decrease the reserve ratio. And here's why the Federal Reserve would want to decrease or lower the amount that banks would have to hold on to, that they could not legally loan out. By decreasing the reserve ratio, banks can then have more excess reserves. The amount they have to hold on to is decreased. They can now loan out more money. What that's going to do is to create more money, because people can then take out those loans. Those loans are going to end up in more banks, and we have that multiplier effect again. By the money supply increasing, the interest rates will fall. That encourages investment spending, which is the component of aggregate demand. So aggregate demand would shift to the right, meaning GDP would increase. If there's inflation, and again, one of the things that the Federal Reserve is concerned about is monitoring and limiting inflation, then they would want to do the opposite. We would call that contractionary monetary policy. So they'd want to increase the reserve ratio, and we could go through the exact same steps. By increasing it, they have to hold on to more, meaning they can loan out less. That means less money is going to get deposited into banks. That decreases the money supply. Interest rates go up. Investment demand goes down. Aggregate demand goes down. Our second tool is the discount rate. And this is an interest rate, so to say, that the Federal Reserve charges commercial banks. So banks like Bank of America, Wells Fargo. Now, we say that they can loan money, essentially, to these commercial banks, but the commercial banks are not going to want to borrow money from the Federal Reserve. gives them a black mark, so to say, hurts their reputation to have to borrow from the Federal Reserve as opposed to another commercial bank, which is what they would prefer. Now, by doing this and setting this discount rate, what they essentially do is set a target. Again, the Federal Reserve knows that very few banks are going to take it up on its offer of loaning money to them at a, let's say, 3% interest rate like you can see on the screen. And what that does then is it sets a target where commercial banks will adjust. They're not going to quite go to the 3%, but they're going to go just under or just above, depending which way you're looking. And so the discount rate becomes much more of a target than actually impacting the money supply directly. So to increase the money supply, the Fed would want to decrease this discount rate. So we want to make it cheaper for people to borrow from the Federal Reserve. At some point, if there's a big enough gap between the Federal Reserve and commercial banks, then it doesn't matter what type of stigma is attached to it, they're going to look for the cheaper money. And so if the interest rate drops, then what they're really doing, or the discount rate drops, what they're really saying is it's now cheaper to borrow money from the Federal Reserve. If we want to decrease the money supply, that contractionary monetary policy, then we want to increase the discount rate. You'll also hear it referred to, instead of expansionary and contractionary monetary policy, you'll often hear it sometimes as easy or tight money policies. The third one is open market operations. Again, fancy name for just buying and selling of bonds. Now, the first two tools that we looked at, the reserve ratio and the discount rate, are very rarely used by the Federal Reserve. The most commonly used tool is this third one, the open market operations, or the buying and selling of bonds. Now think about it. When we talk about buying and selling bonds, we're always saying from the government's point of view. So is the government buying bonds, or is the government selling bonds? There is that other side to the equation. So when you're looking at questions dealing with open market operations, every now and then they may try to trick you and say a bank buys a bond. Well, the inference then is that the government sold the bond. So be kind of mindful of those type of scenarios, but almost entirely you can assume if it just says buy a bond or sell a bond, that is the government actually doing that transaction. So when we talk about open market operations or buying and selling of bonds, what we're really doing is trying to increase and decrease the money supply. When the government buys bonds, what they're doing is putting money into circulation. And so if you want to sell a bond to the government, so the government's going to buy the bond from you, what you're going to do is to hand them the paper for the bond, and in exchange, the government is going to hand you cash. They just purchase the bond off of a consumer. What that does is the consumer no longer has the paper that represents the bond, but they now have the cash that then goes into the money supply. Same is true if we want to decrease the money supply. The Fed should sell bonds. By selling bonds, the consumers would have to hand over cash in exchange for the bonds. The bonds still have the value of that cash plus whatever interest is paid. But what the Federal Reserve has done is change that money that you use to pay for those bonds from M1 to M2, therefore taking it out of the money supply. So the easiest way to remember the impact that buying and selling bonds has on the money supply is simply buy big, sell small. When you buy bonds, the money supply gets bigger. When you sell bonds, the money supply gets smaller. The federal funds rate is different from the discount rate. The federal funds rate is actually what commercial banks charge other commercial banks. Now, banks are going to make these kind of one-day or very temporary loans to each other to make sure that they meet that first tool of the Federal Reserve, that reserve ratio, the reserve requirements. And so banks, on a day-to-day basis, they assess the money that they have, see what money's come in and what money's been withdrawn, and they may have to make loans to one another so that they can cover and meet the required amount by federal law. Now, this federal funds rate, again, is the transaction between commercial banks. And so the Federal Reserve does not have the authority to dictate to these banks what the interest rate they charge should be. The Federal Reserve does offer that discount window or the discount rate to these commercial banks should they not be able to find another commercial bank to make this transaction with. But again, they'd rather deal with another commercial bank than have to run to the Federal Reserve. And so what the Federal Reserve does essentially, by using open market operations and the discount rate, is try to manipulate this federal funds rate. So since they can't directly tell banks, here's the interest rate we want you to charge other banks, they can manipulate the money supply in a way that would raise or lower the interest rate that banks charge other banks. So think of the federal funds rate as sort of the target that the Fed wants these commercial banks to hit. You can see in the crisis, the Great Recession that we had started in 2007, 2008, how the Federal Reserve tried to manipulate the interest rate through the federal funds rate. And so you can see what ultimately happened with the federal funds rate in 2008. You see they start making changes to the money supply that force banks to drastically cut the interest rate. Again, the Federal Reserve wanted interest rates to go low so that they could try to stimulate investment spending, which would boost aggregate demand, which would boost GDP. The problem is before the economy grew to the point where we needed it to go to, again, think ADAS back to full employment, is the federal funds rate fell to 0.25%, so a quarter of a percentage point. That's effectively an interest rate of zero. You can't go any lower than that. And so what happened was the federal funds rate was so low that the Federal Reserve lost their most powerful tool of manipulating interest rates. So a quick review for you. Last unit, again, we talked about fiscal policy, so you can see what you would do for expansionary and contractionary there, but you can also see our new monetary policy tools, the reserve ratio, the discount rate, and the buying and selling of bonds. Just as a reminder for our monetary policy tools, while we have three traditional monetary policy tools, the buying and selling of bonds is the primary tool of the Federal Reserve, those open market operations. The reserve ratio, the discount rate remain relatively unchanged. The Fed is hesitant to change those simply because it takes a long time for banks to adjust to those, particularly the reserve ratio. And so they'd rather try to change interest rates through the buying and selling of bonds. Until next time, this was an overview of the tools of the Federal Reserve for monetary policy.